Most people know that having a good credit score is important. It affects everything from getting approved for loans to renting an apartment or even landing a job. But what if I told you that many of the things you think you know about credit scores are actually wrong? And believing those myths could be costing you hundreds or even thousands of dollars every year. Today, we're busting the biggest credit score myths that might be hurting your financial health without you even realizing it. Let's start with the first myth. Checking your own credit score hurts your credit. This is one of the most common misconceptions. The truth is, when you check your score using tools like Credit Karma, Experian, or your bank, it's a soft inquiry. It doesn't affect your score at all. Only hard inquiries like applying for a loan or credit card can temporarily lower your score. So checking your own credit is actually a smart habit, not a bad one. Next up, myth number 2. You need to carry a balance on your credit card to build credit. False. You don't need to pay interest to improve your score. What really matters is using your card responsibly and paying your bill on time, in full. Carrying a balance only costs you money and interest. It doesn't help your score at all. Myth number 3. Closing old credit cards boosts your score. Actually, it can do the opposite. Credit scoring models reward you for long credit histories. When you close an old account, you lose that history, which could slightly lower your score. Unless the card has high fees or risks, keeping it open often works in your favor. Now let's talk about myth number 4. Your income affects your credit score. It doesn't. Your income isn't directly factored into credit scoring at all. Someone earning $50,000 a year could easily have a higher score than someone making twice that, simply because they manage credit more responsibly. Myth number 5, paying off debt gives your credit score an instant boost. Not quite. Paying off debt is always a good move, but scores don't rise overnight. Some accounts take time to update, and old late payments or collections can still appear on your report for a while. The real key is consistency and long-term good habits. Myth number 6. Your credit score only matters if you're applying for a loan. In reality, your score affects far more, from insurance rates to rental applications, and even some jobs. Building and protecting your credit is an essential part of your financial foundation. And finally, myth number 7. All credit scores are the same. Not true. There are dozens of scoring models like FICO and VantageScore, and each calculates things slightly differently. That's why your score might vary across apps or reports. The important thing is focusing on the big picture. Paying on time, keeping balances low, and maintaining healthy credit habits. So let's recap. Checking your score doesn't hurt it. Carrying a balance doesn't help. And closing old cards can actually work against you. Your income doesn't directly affect your score, and paying off debt takes patience. The bottom line? Understanding how credit really works will help you save money, avoid mistakes, and unlock more financial opportunities. Remember, your credit score isn't just a number. It's a reflection of your habits. Build it wisely, and it'll open doors for your future.